Greetings, grade 12 learners. My name is Mr. Simbi and welcome to today's accounting class. In today's class, I'm going to be looking at majority shareholding, corporate governance. So in today's class, I also have some subtopics that I have. I'm going to be doing certain calculations on shares. I'll also touch on ethics and internal control. Here are my objectives for today's class. Firstly, by the end of the lesson, you should be able to understand majority shareholding. So I'm going to explain to you what is majority shareholding. What does it mean? If you're a majority shareholder, what does that mean? We're also going to calculate how do we get to a point whereby one is now a majority shareholder. And we're going to do other calculations that relate to shares. We will comment on issues relating to shares and majority shareholding. I'll also assist you to understand ethics and internal control that is related to majority shareholding. All right. So as we're preparing for the trial and the final exam, it is very important that you get to understand which topics come in your paper one. As you're preparing, you need to know, okay, this topic can come in paper one and this one will come in paper two. So in paper one, we expect to see the statement of comprehensive income together with the notes. All right, so this is the one that was previously known as the income statement. We expect to see this one in paper one. And then we also expect to see the calculation of correct net profit after tax, and then the statement of financial position and notes. The cash flow statement and notes is a common question in our paper one. And then analysis and interpretation of financial statements, as well as auditing and corporate governance. But remember, the examiner can as well bring in certain topics such as your fixed assets. Your fixed assets can also be in both paper one and paper two, as well as your inventory valuation. Your inventory valuation can also be made part of your paper one. I've seen past papers whereby inventory valuation, that can be your FIFO, your weighted average, can also be incorporated in your statement of comprehensive income. So as we prepare for paper one, we look at the topics that I've spoken of here, but we can also look at our fixed assets as well as the inventory valuation. What are we talking about when we talk about majority shareholding? What is this all about? Now, a major shareholder, or when you talk about majority shareholding, it is when a person or an entity holds and controls more than 50% of a company's issued shares. All right? So you have to understand that if a person or an entity holds more than 50% of a company's issued shares, that particular person or the entity therefore becomes the major shareholder. This entity or person is considered a stakeholder because they can make substantial, or they've made a substantial financial investment to the company. All right. And then, how does a majority shareholder manage a company? The majority shareholder holds the majority voting rights. Okay, so this is where we get to see them exercising their majority shareholding. When it comes to voting, they have the majority voting rights. Therefore, they have voting power to dictate the direction that the company will take. The personal entity can easily outvote everyone else because they have the majority shareholding, remember. Therefore, they end up imposing their will. They can decide the direction that the company will take. What then are the benefits of being a major shareholder? Are there any benefits if you're a major shareholder? Number one, if you're a major shareholder, you are entitled to a larger portion of the company's profits. In other words, you enjoy a high percentage of the financial gains of a company. That is, if the company is profitable. And also remember when the share price increases. All right. So this is the first advantage or the first benefit of you being a major shareholder. Secondly, major shareholders will have significant control over the company's decision-making process. Remember, I spoke about them having majority shareholding in terms of voting rights. So it means they can have control over the company's decision-making process. They can decide the direction that the company can go in based on them being able to control decision-making processes, including the appointment of board members and approval of important resolutions. So once they can control important resolutions, that means they generally have more say in how the company is going to be run. Thirdly, the ability to elect most of the board of directors and to approve their major corporate decisions. So this is the third point now, that with major shareholders, they have the ability to elect most of the board of directors and approve their major corporate decisions. This is very important because once they can elect most of the board of directors and then approve major corporate decisions, that means they have a bigger role to play in decision making of the company. So they also have a significant influence on the appointment of a company's board members and senior executives. Then number 4, access to critical corporate information. Okay, because they've invested so much, so they are then granted access to critical corporate information. And then they control over management appointments. They also control over management appointments and flexible exit strategies. Okay, then let's go to the next point. Providing a final say on long-term goals and strategic decisions. So these major shareholders, they provide a final say on long-term goals as well as the company's strategic decisions. All right. So on this one, for example, they can approve a decision to take more loans or issue more shares to the public. Major decisions with huge effect on cash. So the first major decision that we can talk about is the payment of dividends. All right. The purchase of non-current assets. We're talking fixed assets here. The disposal of fixed assets. Financial investment or withdrawal of investment. Okay, so these are major decisions that need to be decided on in a company. The issuing of additional or ordinary shares, the repurchase of ordinary shares, taking additional long-term loans, okay, and the repayment of long-term loans. So these are decisions that should be approved or voted by the major shareholder. These are major decisions that need to be taken in a company. And therefore, major shareholders have much of the voting rights. So they can influence one of these decisions or all of these decisions in the direction that they feel it is good. All right. So we're going to do certain calculations, and make sure you have a pen, you have a paper, and our first activity is going to come from the SC, that is February, March 2018. That is where the first extract comes from SC February, March, the year 2018. If you're ready, let us begin. So the information is given here, and we're given 2 years. That is 2017, and here is our 2016. So remember, we read our information from the right to the left. That is 2016 on to 2017. And then we're given the share capital and dividends information, and here on D we have our financial indicators. Now, the first question then reads, calculate the percentage of earnings. Calculate the percentage of earnings distributed as dividends for each year to show a change in dividends payout policy. So we calculate the percentage of earnings that is distributed as dividends for each year to show a change in the dividends payout policy and give a reason for this decision. All right. So you can see in 2016, we have our earnings per share and we have our dividends per share. So one of the most important things that I want to encourage you is to know your formula. You have to know your formula. I know at the back of your question paper, you have the formula table, but that may not help you if you don't know the formula offhand. So it has to be in your fingertips. You have to know your formula. You have to know what comes in and when, and how do you then relate it with the formula sheet that you're given. So we have 2016, but when we come to 2017, you then see that our earnings per share, we are not given. However, we are given our dividends per share. So if we are to talk about the dividend payout policy, formula therefore becomes important. And when we calculate our dividend payout rate, we have to know both the earnings per share and the dividends per share. So in 2016, we can be able to calculate the dividend payout rate, because the formula for the dividend payout rate, it is your DPS, that is dividends per share, divided by your EPS, that is your earnings per share. So in 2016, we can do that, but in 2017, we cannot do that. That means in 2017, we have to get first the earnings per share. And we're told that on 1 March 2016, there were 500,000 shares in issue. A further 200,000 shares were issued on this date. All right. And then 25,000 shares were repurchased from the estate of a deceased shareholder. This information can then assist us to calculate our earnings per share for 2017. Let's see. Remember the formula for EPS. It is our net profit after tax divided by the number of shares in issue. So I'll take my net profit after tax, which is 2,975,000 over here. I then divide it. I want to know how many shares are in issue. So to begin, we had 500,000 shares at the beginning, and we issued a further 200. That makes it 700 now. That makes it 700,000 shares. And then we repurchased 25. That means minus 25. That is now going to give us 675,000. 675,000 shares. Okay. Now we have the number of shares, and we also have our net profit after tax. So we then punch all of this in the calculator. We now say our 675,000, which is, all right, remember you have to start off with the net profit after tax, which is 295,750, 295,750. Then I divide that by the number of shares. All right, I divide that by the number of shares, which is 675,000, which is 675,000 shares. 675,000 shares. All right, and then I then multiply this by my 100 cents. Okay, and then I'll end up now with 43 cents per share. So that means when I come here, my earnings per share, it is 43 cents. 43 cents. Okay, so you can see here 43.8 cents. That was my answer, 43.8 cents. Once I have my earnings per share, which is 43.8 cents, I can now come and calculate the dividend payout rate. When I come first in 2016, I know that my earnings was 23 and my dividends are 20. So remember, it is DPS over EPS. So I take my dividends per share, which is 20, I divide it by 23, multiply by 100, then I get 87%. What that means is, in 2016, the company has given 87% of earnings as dividends. I'll repeat again. In this year, 2016, the company has given 87% of earnings as dividends. But when we go now to 2017, remember our dividends per share, which is our DPS. Remember, it's DPS over EPS. We spoke about that one. So our dividends per share, it is 24. So it's going to be 24. divided by 43.8. Remember, we calculated this one now, the 43.8. And then it will give you 55%. So you can see here now that there's a change in the rate. In 2016, the company gave 20 cents as dividends out of the 23 cents of earnings that the company had made. All right. So it simply means in 2016, the company gave 87% of its earnings as dividends. This has changed when you come to 2017, because in 2017, the company has now given 55% of their earnings as dividends. So we can see now there's a change in the policy. Show a change in the dividend payout policy. You can see a change. It was 87%, now it is 55%. Once the dividend payout rate changes, it indicates to a change in the policy. So the policy has changed from 87% to 55%. Why would that be so? Or what is the reason behind this? Number one, the directors decided to reduce the dividend to 55% for them to retain more funds for future growth of the company. So once directors in their mind have expansion, have growth in mind, they will decide to retain. To retain is to keep. So instead of giving 100% of earnings as dividends, they would give only 55%. That means the directors are retaining 45% of their earnings for future growth and expansion. They can also do this to minimize their cash flow problems, all right? And also, if they anticipate that they're going to have cash flow problems, they'd rather retain and then ensure that they do not have challenges of cash flow. Okay, so this was the first calculation. I hope you guys can understand and you're following. Can I move on to the next aspect? Let's do so. All right, activity number two. Activity number two, if you're ready, let us go. With activity number two, it reads, Mary is the CEO of the company. Her shareholding is as follows. Number of shares, she has 420,000 shares, and the date is on the 10th of January, the year 2022. Now, 900,000 shares were in issue on the 1st of July 2022. Then 75,000 shares were repurchased from the estate of a deceased shareholder at 10 Rand 70 per share on the 1st of October. So these are shares that were repurchased. The question then is, calculate Mary's shareholding on the 31st of September before the repurchase of shares. So we want to know what was her percentage shareholding before the repurchase of shares. She currently has 420,000 shares. So here's our 420,000 shares here, 420,000 shares. And then we divide it by the total number of shares that were in issue here on this day, which was 900,000. So she holds 420. And on this day, there was 900,000 shares in issue. So she was currently holding 50.9%. That means she was a major shareholder because she has 50% of the shares plus more. And here she has 50.9. That means she is a major shareholder. As we continue with the class, I'm going to show you 3 ways in which you can determine how one becomes a major shareholder. Maybe let's just do it. Okay, let's do it now. Number 1, I'm going to call it A, where you have someone who holds 50% plus 1, a single share. That's option number 1. If you hold 50% plus 1 more share, she is holding more than 1 share because she's holding 50.9%. B is when you hold 50% plus 100 shares. So you'd find that certain companies will issue shares in allotments of 100. So that's why we end up saying 50% plus 1. And then C would be 51%. These are all options in which one can calculate whether one is a major shareholder or not. So in this case, Mary is now holding 50.9% on the 31st of September. This is before the repurchase of shares. So something is going to happen that is going to change now the figures that we have here. So let's go to the next part. Calculate Mary's shareholding on the 1st of October after the repurchase of shares. So what happens now after the repurchase of shares? Let's see. After the repurchase of shares, okay, so they are repurchasing 75,000, but they are not buying any shares from what Mary currently holds. So Mary's shares remain constant. The 420 remains constant. And the ones that are going to change is the shares that were in issue. Remember, there were 900,000. But now the company has repurchased 75,000. So it's going to be 900 minus the 75. That leaves us with 825. So we end up with 420 divided by 825 times 100 over 1. And then we calculate that. Let's put that on our calculators together. All right, let's put that on our calculators together. So it's going to be your 420,000, and then we divide that by 825,000. So that becomes 825,000 divided by 825,000. Let's punch that in together, and then that's going to give us now 50.9%. All right, so here we have 50.9%. All right, so let's see if we can comment. Explain how Mary has benefited from the decision to repurchase shares. Okay, so it means here at the beginning, if we punch what we had at the beginning, let's go back to the very first one here, where she was holding 420. Okay, so at the beginning, we would say with the shares that she had at the beginning, remember it was 420,000 shares, and then we would divide it by the 900,000 shares. That is the shares that were there right at the beginning. That would give us that is 46%. Okay, so let's come here. This one becomes 46% here. 46%. Okay, so according to what we had said initially, if Mary now has 46% here on the 31st of September, she was not a major shareholder because she was holding 46% on this day. So she was not a major shareholder because you have to have 50% plus for you to become a major shareholder. But now Mary, after the repurchase of shares, because it changes the number of shares in issue, she now has 50.9. How has the repurchase of shares benefited Mary? Okay, she has now become the major shareholder from 46 to 50.9%. She's now the major shareholder. Okay, let's go on to the next part. And then it says, the independent auditor discovered that Mary had made the decision to repurchase the shares without informing the board of directors. Why should the independent auditor be concerned about this? Here is the first answer. It will be considered to be insider trading, that is the abuse of position for personal benefit. Okay, so insider trading, we're talking about someone who is privileged to information and they can use it to their benefit. That is when we talk about insider trading. So because of her position, she was able to know certain information. Therefore, she ended up using that information to her benefit. And then secondly, the CEO can not make decisions without getting the board's approval. So what she did was incorrect. It was not ethical. It was unethical to say. It is not good corporate governance. That is not in line with the King Code, because this is completely not good corporate governance. Okay, we're moving a bit faster. So now we're on activity number 3. Dear learners, we're going to take a quick 5-minute break. We're going to go for a 5-minute break, and I'll see you after this short break. Welcome back, dear learners. Before the ad break, we did 2 activities, and with me here I have activity number 3, which is from the NSC November 2017. So let's look at the paper and work together. It is Castro Limited and Ronki Limited. Okay, so here's the information. And then we have a question which says, if Henry wanted to retain his 60% shareholding in the company, how many shares would he have to buy and how much would he have to pay? So, very important. Because here, Henry owns 300,000 shares in each company that is in Castro Limited, as you can see. But there is another company that I'll also show you, which is Ronki. And then here we are told that in 2017 and 2016, number of shares here it was 500,000 and here it's 700,000. If Henry wanted to retain 60% shareholding in the company, how many shares would he have to buy and how much would he have to pay? Okay. So let's come here then. You would see that at the starting point, he wants to retain 60%. He wants to retain 60%. So we would say the number of shares that are there in 2017, that is 700,000. So we come here at 700,000, multiplied by the 60% that he wishes to retain. All right. So if you say that, let's quickly put that on the calculator. And then let's see if we say 700,000, the 700,000 shares. Let's come here. If we say 700,000 shares, that's 700,000, then we multiply that by 60%. That will give you 420,000. So that means here it's 420,000 shares that he has to have. Okay. But in 2016, he was having 60% of that 500,000 shares. So let's see how many shares was he having initially. So remember, these shares were 500,000. There were 500,000 shares, and he was having 60%. So that means he had 300,000 shares. So in 2016, Henry had 300,000 shares. In 2017, if he is to maintain that 60%, he has to have 420,000 shares. And remember, he has 300. If he is to have 420, how many shares must he buy? So you take the difference between the 420 and 300. That gives you the 120,000 shares. Those are the number of shares that he has to buy. Okay, so I thought maybe I would show you this is one of the simplest way, or you can simply say the difference between the 700 and the 500. That is the shares in 2016 and 2017. Then you get your 200, then you get 60% of that 200. Then you get the 120,000 shares that he has to buy. Now, if he has to buy 120,000 shares, remember the average share price is 910. The average issue price, rather, the average issue share price. So this is the price at which the shares are being issued at. The average share issue price. It is 910 cents, which is 910, which is 910. So it will be 120,000 shares multiplied by 910 cents. That will give you your 1,092,000. You end up with 1,092,000. Okay, let me move on to the next question. Henry decided not to buy these shares apart from the percentage shareholding. Explain 2 reasons why he has made a mistake by not taking up this option. Okay, now, since he has not taken this option, his dividends would have increased if he had taken up this option. Okay, because more shares would result in more dividends being earned. So he's going to lose out on that one. And then if he had bought the shares, it would have led him to have more capital growth. Okay, And then per share would be bigger on investment. His return on shareholders' equity would have been bigger on the investment. All right. And then now he's going to lose on 120,000 votes at the AGM since he did not buy these shares. He would lose on 120,000 votes at the AGM. Okay, I'm going to move on to the next question then, which is in activity number 4. Can I start activity number 4? Let's go. Activity number 4 then reads, Maurice Masibuko inherited a lump sum from the estate of his deceased grandfather. He bought shares from 2 companies, namely Rizzo Limited and Tugela Limited. The financial year for both companies ended 20 February 2019. Rizzo Limited bought back some of the shares in January 2019. Maurice has requested you as his financial advisor to prepare a brief report that will respond to the questions provided below. So here we have the information A as well as information B. Then required, calculate the percentage of shares owned by Maurice after the buyback of shares, and secondly, the number of shares you have to buy to own 35% of the company. Okay, so let's start with the first one, the percentage of shares owned by Maurice after the buyback of shares, and explain the effect on Maurice's shareholding. So if you look at the value of shares that Maurice has, it is 960,000. If you divide that by the issue price of the shares in 2018, that is 4 rand, it will tell us that Maurice was having 120,000 shares. Okay, so we know that he was having 240,000 shares rather. He was having 240,000 shares. And then of those 240,000 shares, now we know that he was holding 40% of the company's shares, that is in Rizzo. So we want to know what was the total number of shares that were in issue in the company. So we'd say 100 over the 40, that will give us the 600,000 shares. So these were the shares in issue in Rizzo Limited. And then now, we then come and we're told Rizzo Limited bought back 150,000 shares on 1 January 2019. So of the 600,000 shares that were in issue, the company has bought back 150,000 shares. That means now they have 450,000 shares in issue. And remember, he still maintains his 240,000 shares. Yet the number of shares in issue has decreased now to 450. So if you say 240,000 shares, let's do it together. 240,000 shares. So we say 240,000 shares. And then we divide this by the 450,000. This would give us 53%. So he's now holding 53%. All right. He is now a majority shareholder. He is now a majority shareholder. Remember here, he was holding 40%. But because of the buyback, he is now a majority shareholder. Okay. Calculate the number of shares you have to buy if he is to own 35% of the company. That is now in Tugela. So if we look at Tugela here, he's holding 30%. All right. And if he's holding 30%, we can get the number of shares that he's having. We'll say the number of shares in issue, which is your 800,000, multiply by 30%, which is holding, that gives us 240,000 shares. That means he currently has 240,000 shares. Of the 240,000 shares that he has, we would want him to have 35%. This is what they're saying. Okay, so let me break it out again. 240,000 shares is equal to the 30% of the company. We want to see how many shares must he have if he's to hold 35%. All right. So we now say what we want is 35 over what we have, which is 30. So it's 240,000 multiplied by 35 cents over 30 cents, or 30%. And then you end up with 280,000. So it's 240 multiplied by 0.35 divided by 0.30. That will give you 280,000 shares. So if he is to hold 35%, he must have 280,000 shares. But currently he has 240. So you say 280 minus 240. That means he has to buy 40,000 shares. He must acquire 40,000 shares. Okay, now we've come to the last activity for the day, which is activity number 5, which is extracted from the Free State trial exam for the year 2023. I think I still have another activity. Okay, let's see. Let's do activity 5, and then I'm going to talk to you after this one. And then it says, are the relevant information for the past 2 years ended 28 February? And then here's the information. If the company issued all its unissued shares the following year, how much capital could it expect to raise for the company? Okay, so if the company is to issue all its unissued shares, now we are told that the authorized share capital is 1 million. So the authorized share capital is 1 million. And presently, the company has 762,500 shares in issue. So we say that 1 million minus the 762,500. So the number of unissued shares is 237,500. Now, if the company is to issue all the unissued shares, that is, they're going to sell the 237,500. Now we are told if they are going to issue these shares, the shares will be issued at 10% more than the current market price. So the current market price is 240 cents. So we'd say 240 cents, that's 240 multiplied by 110%. In other words, we are simply saying 240 multiplied by 10 cents, you get the answer, and then you add it back to the 240. So hence here we just said 2.4 times 110%. All right. Or, as I said, you break it down like that, you get your 0.24 cents, you add the 240 and the 0.24 cents, you get 264. So if we are to sell 237,500 shares at an increased market price, which is now 264, we would end up with 627,000. That is how much the company is going to raise when they issue these new shares. Next question. John Davids, one of the shareholders, is currently the owner of 400,000 shares. What will happen to his shareholding if all the unissued shares are issued? Show calculations to support your answer. Okay, so currently, John Davids, he has 400,000 shares. So we say his 400,000 shares, we divide it by the total number of shares in issue, which is 762. That gives us 52.5. So he is currently holding 52.5. That makes him a major shareholder. All right. And then what will happen to his shareholding if the unissued shares? How many are the unissued shares? Remember, we have the authorized of 1 million, and currently there is 762 that is in issue. So we're simply saying if he maintains his number of shares, which is 400, and we issue the unissued shares, that simply means we now have 1 million shares in issue. So we divide this by 1 million. We end up with him being the holder of 40% of the shares. So he'll be having 40% of the shares. He is no longer the majority shareholder. That means he is no longer the majority shareholder. Now we're going to do activity number 6. As I told you earlier on, this activity is very interesting. I think after this activity, you will understand much more about major shareholding. So we're going to do activity number 6, which is extracted from the Eastern Cape 2023 trial exam. And here is our information: shares and percentage shareholding. Number of shares 450, percentage shareholding 48%. The director of the company decided to issue an additional 50,000 shares in the new financial year. The issue price is 14 Rand. Calculate the minimum number of shares Lucas must buy to become the majority shareholder. Okay, so we have a number of ways of doing this. Remember what I said earlier on. You can become a major shareholder, number one, if you are to hold 50% plus one share. 50% plus one share. So we would now say number of shares in issue is 650,000. And presently he's holding 48%. All right. So we would say we would issue an additional 50,000. That means our number of shares in issue becomes 700,000. So we'd say the 700,000 multiplied by 50%. That gives us the 350,000 shares. If we are to use this method of 50% plus one share, would now say the 350,000 shares, which is 50%, plus the one share. That gives us 350,001. But presently, remember, he is holding 48%. 48% of the 650. So you say 650 times 48%, he's presently holding 312,000. So the difference, therefore, between the 350,001 and the 312,000 shares which he currently holds is 38,001 shares. That is what he has to buy if he's to become a majority shareholder. Option number two, how you would calculate this. If you are to use now the 50% plus 100 shares, you would still get your 50%, which is 350,000. Then you say plus 100. Hence, you now have 350,100 minus what he holds, which is 312,000. Therefore, here you see he has to buy 38,100 shares. The last option is the 51%. If you say 700,000 multiplied by 51%, you get 357,000. Then you compare it with what he currently holds. He has to buy 45,000 shares. In the exam, you don't have to write all the three options. You stick to one. You stick to one. Either you say 50% plus one share, or 50% plus 100 shares, or 51%. Okay, now, here we calculated the minimum number of shares that he has to buy to become a major shareholder. The second part is to calculate the total amount that he will spend. If you are using option A, you say that 38,001 shares multiply by 14 Rand, which is the issue price. So he has to spend 532,014. If you come to option B, whereby we have 38,100 shares, using the same issue price, it becomes 533,400. But if you use last option C, which is the 51% option, 45,000 shares multiplied by the 14 Rand, that gives you 630,000. All right, so this makes it very easy. And then the last part now, reasons for Lucas to become a major shareholder. Mention 2 points why Lucas wants to become a majority shareholder. Number one, to influence strategic decisions, such as the appointment of directors. All right, to influence strategic decisions, such as the appointment of directors, to influence business operations. And then lastly, he sees potential in the company and wants to become part of the future growth. That can be one of the reasons why he would want to become a major shareholder. Dear learners, thank you so much for joining me in today's class. I hope to see you again very soon. For myself, it is goodbye.